Heading into Monday's session, the Indian capital markets are positioned inside a tightening contradiction. On the daily time frame, the structure appears resilient. A dragonfly-style candle shows buyers defending the dip below 23,950, closing back above 24,000. However, this support exists alongside a put-call ratio of 0.78 and a heavy futures short buildup. Participants are shorting into this very bounce. Adding to this friction is the global risk setup. Reuters reports that Donald Trump has warned the U.S. could resume attacks on Iran unless Hezbollah-linked aggression is restrained. This makes global sentiment headline-sensitive, specifically regarding responses from Tehran that could disrupt Middle Eastern risk assets. For the Nifty, this tension translates directly into crude oil prices. The RBI's June minutes confirm a neutral stance, but they remain cautious of oil-driven inflation, making banking and rate-sensitive stocks highly vulnerable to energy spikes. Because this risk-on environment contains a geopolitical trap, we must move away from directional forecasting and instead construct a reactive execution matrix. Committing blindly to the bounce ignores the bearish derivative buildup, while surrendering to short data ignores the buyers at 24,000. Survival requires mathematical neutrality. The domestic macroeconomic picture provides a base of structural support. The RBI's steady repo rate and neutral policy stance act as a stabilizer for the broader market. This is bolstered by institutional flows. FIIs bought nearly 4,860 crore rupees in cash on Friday, even as SEBI moves to reinstate open market buybacks from August, signaling a supportive environment for capital market sentiment. However, the Nifty faces a heavy sector drag in IT. Following Accenture's weak outlook, the Indian IT index hit a 3-year low, with major heavyweights capping any immediate index-level upside. This 3D view of the June 23rd expiry explains why institutional cash buying hasn't triggered a breakout. Option sellers have constructed a ceiling. We see aggressive call writing accumulating between 24,050 and 24,200, creating massive overhead resistance. Directly in the center, the 24,000 strike is a deadlock. It is currently the max pain magnet, pinning the price between opposing institutional forces. When cash buying is neutralized by a future short buildup, it indicates that institutions are derivative hedging their long positions rather than trading with pure bullish aggression. This establishes a trapped baseline bias. Bullishness is effectively capped until the market achieves acceptance above the 24,200 mark. We define the weekly boundary as 24,200 on the upside and 23,900 on the downside. Control shifts decisively only when one of these levels breaks. Our primary rejection zone sits between 24,129 and 24,173. This is a high-probability reversal area on a gap up, where the classic R2 pivot, Camarilla H5, and 180-degree Gann resistance all converge. The first bull defense layer is mapped between 23,973 and 23,933. This zone leverages the 24,000 max pain gravity, alongside Camarilla L3 and L4 pivots, and 90-degree Gann support. Look for rejection wicks here for a potential bounce. The critical breakdown threshold is 23,900. If price sustains below this level, avoid averaging longs, as the floor opens toward the 38.2% Fibonacci level at 23,800. Executing trades in the void between these mapped confluence bands increases the risk of being caught in expiry week chop. We translate these levels into an algorithmic decision tree based on the 9:15 a.m. opening print. For Scenario A, a neutral open between 23,970 and 24,050, ignore the first candle. This is the observation phase. A long trade only activates if price sustains above 24,053 and holds above 24,090, confirmed by rising put premiums at the 24,000 strike. Scenario B is a gap up above 24,080. This is a potential bull trap. Heavy call resistance often triggers a reversal back toward 24,050, unless the ceiling is broken with significant volume. Validating a true breakout in Scenario B requires a strict 15-minute hold above 24,130 to prove that short covering has begun. Scenario C is a gap down near 23,900. This is an immediate bounce play zone, using the Camarilla L5 and Friday's low as technical springboards. If 23,841 fails to hold, the long bias is aborted. The breakdown target moves to the 23,752 Fibonacci support. By preloading these conditions, the trader replaces predictive bias with reactive execution. The market provides the scenario. We simply apply the rules. This is the master execution matrix for Monday, a single reference guide for the 23,900 to 24,200 range and its critical reversal edges. We can supplement this price data with a second vector of analysis, time. Using Lahiri sidereal calculations, we identify specific windows where a mechanical momentum transition occurs mid-session as the planetary alignment shifts. The 10:18 to 10:32 a.m. IST window is the highest probability period for an intraday reversal. This is driven by the moon's transition into the Hasta Nakshatra, often triggering a reset in the prevailing trend. The final variable to activate this matrix is the morning gift Nifty reading, which will determine our opening scenario. Professional pre-market analysis relies on identifying exactly where the traps are buried and waiting for the market to trigger them. Execute the matrix, not the forecast.